Think about the last time you opened your annual performance statement. You weren't even nervous. You were proud. You didn't chase hype. You didn't panic sell. You picked the safe option. Then you see the number. It's fine, not terrible, just weirdly muted, and that's the part that messes with your head. Because you also remember the headlines. Markets were up. Your coworkers are casually dropping bigger percentages. Even your own 401k dashboard looked like it had a decent year. So you start doing that little mental math loop. Did I pick the wrong fund? Are the fees eating me alive? Did I somehow miss the whole rally while still taking risk? Here's what most people don't realize. Sometimes your return isn't underwhelming because you did anything wrong. It's underwhelming because the product you bought has a quiet built-in break. It feels disciplined. It looks conservative, but it can quietly shrink what you keep, especially in the years you expected to finally catch a break. Let me be clear about something. A lot of safe funds aren't fully invested. They keep a meaningful slice of your money in cash or cash-like holdings. That can mean cash and cash equivalents, money market instruments, short-term treasury bills, or other parked buckets that exist for liquidity, basically, quick access money. And when part of your dollars are parked, that part earns less. Your statement doesn't scream this at you. It shows one blended performance number, like you were 100% in the strategy the fund name implies. Conservative, income, balanced, low volatility. Those labels feel like a seatbelt. But under the hood, you can be riding with one foot on the brake the entire time. This isn't a tiny edge case either. A published study on mutual fund cash holdings found the average cash holding was 5.33%, with a big spread across funds, some holding over 14% in cash on average in the highest cash group. That's the mechanism. Even if markets rise, your blended return gets pulled down by the portion that's effectively sidelined. Then inflation, price increases over time, takes a bite out of what that cash can actually buy. Here's the twist. You're paying for the feeling of stability with a performance haircut that compounds. And once you see where the haircut comes from, you start noticing it everywhere. So now you need a name for what you've been experiencing. Cash drag is the performance gap you get when part of your portfolio sits in low-return cash-like holdings while the rest of the market moves. Picture a car with the gas pedal down, but the parking brake slightly engaged. You still move forward, just slower than you think, and it shows up in more places than you'd expect. Conservative allocation funds that keep a cash sleeve, income funds that want a buffer for payouts, target date funds that get more conservative as retirement gets closer, and strategies that hold dry powder or liquidity to handle redemptions. When other investors pull money out, the math is painfully simple. If a fund is 20% cash earning 4% and 80% invested in assets that return 10%, the blended return is 0.20 times 4% plus 0.80 times 10% equals 8.8%. That's 1.2 percentage points of return gone versus being fully invested in the 10% piece. And the worst part? You can do everything right, behavior-wise. You can stay invested all year. You can avoid emotional trading. But if the fund is permanently holding a chunk in cash, you're permanently on the sidelines with part of your money. For you, this changes the question you ask. Not, did the manager do a good job, but how much of my money was actually working? Because a fund can be safe and still quietly guarantee you lag in up years. Now comes the part most people never calculate. How this drag turns into a real dollar gap once inflation and compounding show up. Once you spot cash drag, the next trap is thinking it's small. A percent here. A percent there. Who cares, right? But inflation and compounding make it bigger than it feels. Inflation is the rise in prices over time. If your cash earns less than inflation, that slice of your money is losing purchasing power even while your statement looks stable, and inflation hasn't been gentle. The CPI, the Consumer Price Index tracked by the U.S. Bureau of Labor Statistics, showed 12-month inflation at 6.5% in December 2022 and 3.4% in January 2023. So in periods like that, earning something on cash still might not be keeping up with the real-world cost of living. Now stack that with a constant cash sleeve. Say you're in a fund that keeps 20% in cash-like holdings. If your invested portion has a 10% year and your cash portion earns 4%, you already saw the blended return becomes 8.8%. Run that over multiple years and the gap compounds. Compounding just means your gains earn gains. So when your return is shaved each year, you don't just lose that year's performance, you lose the growth that performance would have created later. This is how you end up feeling like you're doing everything responsibly, but the finish line keeps drifting. Down payment timeline, college goal, retirement number. They all get a little harder because your fund baked in a headwind. And here's what most people don't realize. Cash inside a fund isn't always a mistake. Sometimes it's a feature you actually want. The real problem is when it's accidental, and you didn't choose it on purpose. You can now see the drag. But the more important question is why it's there at all, and when it's protecting you versus quietly protecting the fund company. That's where your leverage starts. Because cash inside a fund can be either a seatbelt or a blindfold. Reasonable cash is purpose-based. Money you'll need soon. Known bills. An emergency buffer that keeps you from selling investments at the worst time. That kind of cash belongs in a place you can name, measure, and sleep with. Accidental cash is different. It's when the fund keeps a permanent liquidity sleeve, and you never agreed to that trade-off. It's marketed as discipline. It shows up as smoother quarters. But your long-term return pays the bill, and there's a real operational reason managers do it: redemptions. Funds have to be ready when other investors pull money out. In market stress, that pressure spikes. During the March 2020 turmoil, one research paper on open-ended funds found average cash buffers around 9% of total assets, and it notes that a 1-week redemption notice period was associated with about a 2 percentage point smaller increase in cash buffers during that period. Translation: when a fund doesn't have friction to slow withdrawals, it has to defend itself with more cash. Now put yourself in the shoes of responsible Riley. Mid-career, picks the conservative option in a 401k to be smart. Already has an emergency fund. But the 401k fund also holds a persistent cash chunk, just in case. Riley isn't choosing safety. Riley is duplicating cash, and paying for it with years of muted compounding. So who benefits? You get fewer scary swings on the statement. The fund company gets fewer complaints and fewer panicked investors leaving after a bad quarter. And you quietly accept a lower expected outcome. So what do you actually do with all of this? Without turning your life into a finance spreadsheet, here's exactly what to do. No theory, just a quick checklist. Step 1. Find the cash number. Open the fund's portfolio or holdings page. Look for cash and cash equivalents, money market, T-bills, short-term investments, or a big other bucket. Write down the percentage. Step 2. Sanity check performance. Pull up a comparable benchmark for the same risk level, like a conservative allocation index or a target date peer group. If your fund is consistently lagging in up markets, cash drag and fees are the first suspects. Step 3. Decide your purpose cash first. Emergency fund. Near-term purchases in the next 12 to 36 months. If you already have that outside the fund, you don't need a fund secretly running extra cash on top. Step 4. Choose a cleaner risk dial. If you want lower risk, pick something with a transparent stock-bond mix instead of a mystery, conservative label. Then verify the cash sleeve is small unless you explicitly want it. Step 5. Run one rule. If cash inside the fund is over 5 to 10% and you already have emergency cash, you need a specific reason to accept that drag. Step 6. Implement safely. In a 401k or IRA, start by changing new contributions first. Then rebalance gradually. No dramatic timing games. If this felt like the kind of hidden mechanic nobody spells out, you'll want the next breakdown on how to read a fund's holdings page like a forensic report. Subscribe for more of that. And if you want help, comment the fund name and the cash percent you found.